Hi, this is Brian Vendig, president of MJP Wealth Advisors. Hope you all are doing well. Thought it would be a great time to provide another quarterly market update. A lot has transpired over the last couple of months, and we're right in the middle of earnings season right now for publicly traded companies, and thought it would be great to kind of distill all the information that we've received over the last few months so far from the markets, talking about earnings, inflation, interest rates, what the Fed's going to do and how the economy's doing, and package it all together to give you an outlook on our view of things for the balance of the year. So with all that being said, I'm going to share my screen and walk you through a couple of slides that's going to help to support these perspectives. So as we entered the year, if you remember, bullish sentiment was actually quite high coming into January of 24. This was on the heels of the Fed announcing rate decisions. They're not going to increase interest rates this year and actually looking to cut rates, set the market to new highs as we moved into the year because of the expectation that the Fed was going to cut rates 6 times. If you recall from our prior conversations here at MJP Wealth, we are not looking for rate cuts on the magnitude of 6 times this year, but definitely around 3 or so for the balance of the year. At the same point in time, we also talked about an improved earnings environment, which I still think will happen over the balance of the year. And that was both were kind of supporting expectations from investors that the market could grind higher over the balance of the year. So what we've seen right now is that we do have a positive equity market so far on a year-to-date basis. We also have seen interest rates increase since the end of last year, which has actually caused bonds to be down on average of about 3% so far year to date. But the pieces that I want to kind of talk about today, which will factor into our outlook, is let's start with the equities part of the discussion and looking at valuations in the market. Now, last year, we had an AI frenzy, if you remember from our prior conversation, where a few handful of mega cap tech stocks contributed to anywhere between 70 to 90% of the returns at any given time in 2023. That has pushed expectations when you look at price over earnings. So the price of what something is trading in the public markets over the expected earnings growth moving forward of that stock, for larger stocks to be above historical averages. And as this slide is dictating, we're looking at a forward price to earnings ratio of about 21 as compared to a historical average of about 17. The reason why the S&P 500, and you hear this from the media, that maybe is the market overvalued, is because about 40% of that market weighting in value is coming from mega cap tech, or about 7 names in the overall market indice. And those stocks are kind of part of that Magnificent Seven complex that you hear about: Amazon, Alphabet, Apple, Microsoft, NVIDIA, Tesla, and so on. So the point that we're looking at is that we do have exposure in your portfolios to those growth names or those names that can provide opportunities for innovation moving forward, but we want to be kind of choosy on price. We don't want to have too much allocated to that bucket. So we're also looking at other areas of the equity market that we think that are somewhat fairly attractive. And that's where we look at, in the large cap area, that was what we'd call value stocks, things that are in the industrial, basic materials, healthcare, financial sector, but also want to highlight medium and smaller companies, which we also have in your portfolios as well, because their price to earnings ratios are well below historical average. So we're looking for improved earnings coming from companies outside of just large cap, but we also are expecting improved earnings in areas outside of just tech in the large cap space. So these are some of the things that we're looking for, which we think are opportunities for growth over the balance of the year. And also that if we see some participation in some areas outside of tech, can also help to support the markets grinding higher, and also valuations in the market on an overall basis. Now, you can get a better sense of this disparity in valuations when you take a look at those magnificent 7 tech names that I mentioned before, with a forward PE of around 31 as compared to 21 in the market, and then everything else kind of trading at 19. Those differences there are what we're being sensitive to help you and your portfolios in managing volatility, because we've seen that when the market gets nervous about things, it's the areas of the market that have these higher PE ratios are the ones that sell off more than some of the other sectors. And that's what we're trying to be sensitive to as we move through some adjustments that are happening and we expect to happen over the balance of the year, which I'll get to. Now, when we look at the overall earnings forecast for the year of where the market could go from a valuation perspective, this slide is dated by a couple of weeks, but I would say the majority of analysts who were here in the middle, and again, we're looking at the equity analysts from some of the various large investment banks and banks that are out there, have moved their estimates more over to the left here. We're expecting the S&P being above 5,000 and around 5,400, somewhere in that range. We're definitely in that camp because we're looking at it from the standpoint of earnings growth, wider participation of stocks outside of tech, inflation coming down and rates coming down. And these are some of those macroeconomic things that you hear about that are kind of rebalancing as we're moving through the year. What's inflation doing? What's the Fed going to do for rates? That story is going to be dull and boring. You're going to hear a lot about that from me, I'm sorry, but also from the media as well. But this is all what kind of gets baked into the cake when we think about where the market's going to go. Now, for the month of April, as I said before, we're in the start of earnings season. We've had 2 weeks of earnings prior to. We're in the week of April 22nd right now with this recording coming out specific to this week. Chock full of earnings in front of us. The market is going to be listening to some of those mega cap tech names like I talked about. For example, on Thursday, we're going to hear from Microsoft and Alphabet, which is Google, Meta on Wednesday, Tesla on the 23rd today when I'm doing this recording. And we've heard, and we're going to be hearing from some other names outside of tech in some of these other sectors. So this is something that we're paying attention to. What we're seeing as a trend is that for companies that have reported, though, thus far this month, 79% are beating their revenue expectations, 55% are beating their profit expectations, which is good. But what investors are paying really close attention to, so as we are what are the outlooks for these companies? Are they holding true with their estimates for growth over the balance of the year? Because when we look at earnings estimates on overall basis for the market, we're expecting operating earnings to grow 9 to 11% year over year for the market, S&P 500 on an overall basis. So companies that hold those outlooks and say they still have the potential for growth are doing well. Companies that are adjusting those outlooks and saying that, nah, they're not as strong as I thought they would be, are getting punished. And so that's why having a selective view, which is what we're using between growth versus value stocks, as I said before, and not always just being over-indexed to the winners from last year, is the way we're going to get through some of these adjustment periods this year. So got to be patient as an equity investor. We got to give some time for these earnings reports to come out over the balance of the year, because we're expecting those earnings numbers to improve as the year goes on. So patience is fortitude in 2024 is what I'm trying to say. How to support that to make that even more crystal clear to all of you is let's take a look at where we were last year and the year before to where we are expecting to go this year. As I said before, mega cap tech was the biggest earnings contributor in 2023. We can see that here on the slide highlighted in green for 2023. How did tech companies do that? Mag 7, Magnificent 7 stocks as compared to everybody else. But as you can see in 2024, that's the broadening out that we're hoping for, and that's what we're expecting. So as the year goes on, a little more participation from other areas outside of tech. But as I said in that equity portfolio, having a little growth paired with value gives us our way to kind of balance out as things play out over the next couple of quarters. Where does that leave us from an economic perspective with the economy? It still looks like we are going to get slow growth from the U.S. economy over the course of this year. We have a stable labor market. Consumers are still spending money. We'll talk about that in a second. At the same point in time, the Fed is trying to be very balanced in their approach. We know some of the inflation numbers have come in a little stickier than expectation. We're talking about tenths of a percentage point, just to be clear, okay? But at the same point in time, can they maintain these rates without driving the economy into a recession? Probabilities are still looking pretty good. So we're staying in that camp, and that's also where the majority of market participants are as well. Now, I talked a little bit about equities, which is saying, yes, we're positive on equities for the year, being diversified, but let's also talk about bonds. Bonds are going to return, hopefully, some value for us as the year goes on. How's that going to happen? Well, one, we need to see interest rates come down. How are interest rates going to come down? Well, the Fed needs to help us a little bit with some monetary policy adjustments by cutting rates. Number two, we need to see inflation come down over the balance of the year. And number three, investors need to see that the U.S. economy is in this slow growth mode. We just finished Q1. We're going to get a GDP number on that. We're going to get some more inflation numbers. But I think this is, again, this great rebalancing that we're going through, the unintended consequences of policy decisions from COVID in 2020 and 2021, when the money supply grew and interest rates fell and inflation went up. Now we're dealing with the unintended consequences of rolling some of those policy measures back as inflation's coming down, and we're going back to that slow growth economy that we had back in 2019 as we went into 2020. So if you look at this slide, what does this mean for bonds? BP stands for basis points. There's a fancy way of saying interest rates. So assume I'm focusing on the column here of 50 basis points or 50 BPs, which means 0.5% or 0.5%. If rates come down from where we are right now by 0.5%, we can expect shorter duration bonds, and I'm talking about anywhere between 2-year to 10-year bonds, and that's where we have the majority of your fixed income in your portfolio is allocated. That is 0.5 percentage point comes down over the next 12 months, we could expect bonds to go up 5 to 8%. This is a very attractive number. We haven't been in this place for a while. Why are we in this place? It's because 2022 was a really tough year for bonds. In 23, we saw a rally in bonds in the fourth quarter when the Fed said they're not going to raise rates anymore and pivot. We haven't been seeing that type of rally in bonds just yet because rates ticked up higher because the market got too excited last year. But I think as rational views start to manifest over the next 3 to 6 months, we're hoping that rates will fall is our outlook. And as a result, we might start to see some appreciation from bonds. That's our view. That's what we're holding to over the next 8 months. And bonds is a part of our portfolio. We own treasuries. We own short-term bonds. We own some other type of investment grade rated bonds, corporates in your portfolio, as well as municipals, depending on if you're in a taxable account versus an IRA. So bonds is something that we think might be an opportunity as well moving forward that we're keeping a close eye on. But again, wanted to provide the reasons why we're still invested in bonds and where we think they might go. Now, we know we just came off of a tough week in the market, toughest one so far this year, and also going back the last couple of years. We saw the markets were sitting in a pretty nice position at the end of the first quarter. We got some news, obviously, between a potential conflict expanding in the Middle East that gave investors pause last week. We also got some mixed earnings views in the market and also some concerns about inflation and interest rates actually increasing, not decreasing, as I just said. One of the Fed officials, John Williams out of New York, said that depending on how the inflation story goes with the economic data the next couple of months, they might even increase interest rates. Well, all those things came together, which caused the market to take a step back from some of the gains that we saw in the first quarter. But what I'm trying to show you here is that it is a very traditional, a very orderly market process that we saw last week, where market came down a couple percentage points, as we saw, anywhere between 4 and 5%, depending on where you were invested. This is very traditional, happens in the market on average every 3 to 4 months with a little bit of a pullback, and we've seen that trend play out for many decades. But last week was a specific week on some of those concerns. Showing this to you because we haven't seen a pullback like that for a while, considering the market has been doing well since October. But we're seeing that our indicators are showing that we were in a little bit of an oversold position in some areas, especially in the mid cap and small cap stocks, because a lot of that sell-off was due to the concern of interest rates going up and not going down. Because again, access to capital for medium and smaller companies are different than for larger companies. We think that might be a little bit overdone if we get some good earnings this week, and on Friday we get a good read on an inflation indicator. We might be able to see the market, bounce back from this. But again, keeping a close eye, because I think this year earnings is going to drive the story, as well as the next couple of months of inflation reports. Now, one thing I will mention is that, if you look back at history, as you know, I like the famous Mark Twain expression, history doesn't repeat itself, but it often rhymes. Mark Twain said that, as I mentioned. History has shown, when you look back to 1946 and you look back at a 5-month move that we've had in the markets, like we've had going back to the end of October to where we are now, you can see that markets actually perform quite well when you go out several months. So you go out 12 months out from those periods of time, you see a return of around 21%, and then you take a look, 6 months later with an average return around 8%, and 3 months later 5%. So again, these are another reasons why we're still staying constructive on equities, because of the earnings story, because of what history has shown, and also because the story that we're seeing from the Fed with a potential rate cut still in the cards for down the road are all things that should be positive, both for the financial markets and specifically in different aspects of stocks and bonds. The other thing I want to highlight here goes back to valuation. Again, that history doesn't repeat itself, but often rhymes. Back in the late 90s into early 2000s, we saw the tech bubble burst, totally different situation. I'm not saying that's what we're dealing with right now with the AI frenzy, but when those higher areas of the market sell off, then higher valuation areas, I should say, sell off, then that usually drags the market down, but it's not necessarily true for all sectors. So in the early 2000s, we saw value stocks and small caps and real estate perform better, even though, tech sold off and dragged the market down. We've seen recently that if you look at last week, for example, tech sold off. That was the hardest hit area of the market. It then contributed to the overall market selling off, but not as bad in some other areas. Same thing back in October of last year, we got a market correction as well, and that was led by the tech stocks selling off and dragging down other areas. So again, that mix between value versus growth is really important, especially considering where we are in the market cycle, and just, again, trying to highlight some of this thinking to you. Now, when we take a look at publicly traded companies, how are they able to generate these profits in this environment? Well, they've managed costs pretty well on their balance sheets. Supply chains have normalized. They've locked in debt with fixed rates at low rates previously. A little bit different where publicly traded companies sit right now today as compared to going into the financial crisis. And even smaller companies have also done the same thing, where they've locked in rates at low interest rate borrowing rates. And again, little differences here between large and small, which sometimes factors out into performance for equities relative to that interest rate story, like I said. But when we think about the Fed and rate cuts, I think before you've heard me say that we were in the camp of 3 rate cuts for the year. With inflation coming in a little stickier, the number of rate cuts this year might not be the most important point. I think it might be how much the Fed will cut in interest rates. So they raised rates, in the past in meetings, 0.75% or 0.5% in every meeting. it is also possible that they could cut rates more than 0.25% in a single meeting this year. So I'd like to see the Fed cut rates definitely in the second half of the year. And the probabilities are looking like those rate cuts would probably more likely happen in September if we don't see sequential improvement in interest rates over the next several months. So it's something we're keeping an eye on, but we still think rate cuts will happen because based on different measurements of how rates impact the economy, I think the Fed is going to be very sensitive to make sure that they don't hamper growth at the impact of higher rates, especially in the fact that we're in a presidential year as well. Where the market is pricing in rates, moving forward, you can see how those adjustments have changed in the green line back in January to kind of where we are in April. Again, that's just indicative of less rate cuts on the table for 23, for 24, based on where market participants are today versus where we were last year. And even the probabilities of seeing no rate cuts factor in as well in market participants' minds, but that's still a very de minimis view as compared to some of the other probabilities. But again, something we're aware of that we're watching. As you think about where rates could go into the future, this factors into our view on fixed income. As I said before, as interest rates come down, then bond prices go up, and we're looking at an environment moving forward that we'll be moving into lower interest rates because inflation will be lower and because we'll be moving into a slower growth environment. This is a great reminder of where we've come on inflation. Unfortunately, for those that are skiers and caught some skiing towards the end of the season here, we're on the downside part of this slope from where we were previously at the top of the mountain in June of 2022. But so that's a good news story. But what we're seeing in the inflation indicators is there's some lag effects. Right now, those inflation indicators are a little hotter because of some adjustments coming through with auto insurance premiums being higher. That's driving up inflation numbers at the beginning of the year. With also some lag effects in how inflation is being calculated, housing being a big input. And you can see here on the green line that the government's using a rate of around 5 to 6% in their inflation numbers. But when you look at what's going on with housing prices around the United States, on average, not talking about one region versus the other, the inflation numbers actually are not, or the price numbers are not as high. So we think that as the year goes on, some of these normalization effects or rebalancing of the way some of these things are being calculated in the inflation numbers will pan out, which will help to cause some of these year-over-year inflation numbers to come down. So it's a little bit of aspects of calculation and timing. The other part that's impacting inflation is consumer spending. And I think this is the part of the story that is taking a little bit more time to play out. Consumers are still spending money, but we're expecting them to spend money at a lower clip moving forward, or a lower rate moving forward, because household savings rates have definitely come down. There's less, the free money from the pandemic, so to speak, has been burned off. We're seeing credit card balances go up, auto loan balances and default rates going up. We're seeing higher mortgage balances now to buy a home that's now worth more. So eventually the consumer is saying that they're managing through with higher prices, but I think those higher prices are causing consumers to be more choosy on where they spend their money based on price. We've heard that from retailers. We've heard that in other company outlooks on what they're seeing from their consumer segments. And so as a consequence, people are getting paid less year over year than they were a couple of years ago. So the reason why people are still spending is because their wages are still slightly up year over year. However, as we know, inflation is not equal for all things. And so inflation for some things are higher than what people are getting paid. And that's, as a result, I think, going to bake into lower consumer spending over the balance of the year. Supporting less spending means less impacts on inflation. Inflation then comes down. And then also the economy starts to slow a little bit more moving forward. Lastly, let's talk about small business as a big part of the U.S. economy. And again, 70% of the U.S. economy is services-led. And that's really the part that is connected to these inflation comments. We're seeing the optimism of small business owners also coming down as well, because they're saying, to get sales numbers now are more variable. Their sales are changing depending on what type of industry you're in. So we're getting the sense that the economy is slowing. We're getting the sense that the consumer is being a little choosier on price, but we're also getting the sense that earnings are growing or having the chance to grow for publicly traded companies in areas outside of tech. And when we put all this together, that gives us a sense of where we find some opportunities in the bond market and the stock market, where we're trying to focus on things and managing volatility for you within your portfolios. And again, as we get more and more updates throughout the year, we'll continue to update these videos for you. But the other thing that I would like to highlight is also coming back to ways to connect with us as a firm. So please, we send out our ongoing weekly client newsletter, and that we've now moved that to more of a bi-weekly or a couple times a month process, because we don't want to overwhelm your inbox with communications from us. We also have a pretty interactive website, where we also provide information as well. So just to remind everybody, you can come to our website. You can take a look at different parts of our website, such as our news and insight, to get updates on when we're making comments publicly about things and providing updates. You can also access your accounts through the client access portal and click on the MJP client portal. We also have an app that complements this, white label in the App Store, MJP Wealth. Great way to get updates through our news feed, other news feed items, also stay up on your accounts, as well as you can access any tax forms and any statements from Schwab. And then also there's a link here in case you want to explore our online savings account portal, FDIC insured, completely complimentary, 5.3% on cash savings. But my point is, using the news and insight and accessing the client access are other ways to stay in contact with us. Plus, we also have various social media pages for those that are interested. So follow me on LinkedIn, follow the firm on LinkedIn, Facebook, X or Twitter. These are all ways to get content from us as well when we push things out. So I encourage you to do so as well, or just drop an email to advice@MJP Wealth Advisors. In case you're having problems connecting, we want to make sure that we can help to support you. But again, we appreciate your time with this little bit longer update message. And if you have any questions, please feel free to reach out to a member of our advisory team or our client service team. We're always happy to help you and keep you informed. But again, I'll be providing more updates along the way, but this is where we're sitting right now, and we're keeping a close eye on things that are going on in the financial markets, Federal Reserve policy, and other policy measures that are out there. So thanks so much. Appreciate your time, and hope you have a great rest of the day. Bye-bye.